The Aussie tech sector has seen some amazing growth in the last few years, and especially so just in 2020 alone, where the tech companies have been on an extremely hot run, returning 13% versus the ASX losing 12% in the same period. So in this video, I'm going to cover why I think this might not necessarily be a short-term fad, and how you as an investor can gain access to this rapidly growing Australian tech industry right here on the ASX. So in February 2020, the S&P actually created a brand new index in partnership with the ASX to actually track these Australian technology companies. The index is actually called the S&P/ASX All Technology Index, and was actually created now because in the last 5 years, the number of companies that would actually have qualified for the index has almost doubled from 24 to 46. This has actually made the index diversified enough and full enough to actually be worth tracking and potentially invest in. Previously, when there was only, 12, 24, 30 companies, it's probably not a big enough index for you to think about investing in because it just wouldn't have been diversified enough. But what's super interesting actually about this index is in that same time period, the last 5 years, the market capitalization of these companies has, instead of just doubling, has actually gone from 17 billion to 92 billion. So while the number of companies in the index have only doubled in that time, the market capitalization of these companies has gone up almost 5 times in the same period. This really starts to illustrate the kind of growth these companies are seeing when you compare it to the ASX 200. And this market capitalization growth that you see really does follow the sort of macro trend of the technology industry in Australia and the number of companies that are listing on the ASX that are actually technology companies. In the last 5 years, the number of actually listed technology companies has doubled in that time as well, from 100 to over 200 now. So you're probably thinking, what actually qualifies a company to be a technology company and qualify for this brand new index that the ASX is tracking? So the requirements are right on the website in this nice little infographic, where companies, to qualify for the index and remain in the index, they have to have a market capitalization of at least $120 million, have a minimum of $120,000 worth of value traded every day, a minimal investable weight factor of 0.3, and a minimum relative liquidity ratio of 30%. I think what's probably been the most reassuring performance metric of that new Australian Technology Index is just the extreme outperformance it's seen compared to the ASX 200 through COVID-19. So even though the index and the ETF that tracks the index was launched right before the COVID-19 pandemic and the subsequent market crash, since the March lows, it's actually gained 73% in that time, which at the time of this video meant that it's already returned a positive 2.8%, which actually means year to date, the index has been positive, whilst in the same period, the ASX 200 is down about 12%. The long-term performance of the Australian Technology Index has been equally, if not more impressive. But you know what would be really impressive? If you smash that like button for the YouTube algorithm. Anyway, if we go back to 2014 and actually look at the index from when it started and tracked it to now, and you look at it compared to the ASX 200, you can really see the widening gap between that Australian Technologies Index and the ASX 200, and it doesn't seem to be slowing down. The next point I really want to talk about is why I think it's important, if you're going to back an industry or sector, you need to do it in a diversified way. You can't just put all your shares in Afterpay and Zip and hope for the best.
This is the part where we blow up! Not today!
As none of us are really good enough to pick stock winners consistently, and we might get one lucky once or twice, but it's really, really difficult to consistently pick these winners, and over the long run, you probably just won't. So why is that? So in 2020 alone, we saw huge volatility within the index itself. 7 of the companies actually went up by 30%. This was led by Pushpay, which went up around 80% year to date, and then Afterpay, which has gone up around 65% as well. But on the flip side, and why it's important to be diversified, is that 9 companies have actually declined by 30% or more in that same time period. So I know I've already said it, but this is why I think it's so important. Even if you back the Aussie tech sector, and it is something that I believe in, it's super important to be diversified because you just won't be able to pick the winners consistently. So whilst I personally do believe in the Aussie tech sector and do think it's going to be something that's going to be great for long-term growth over the next, 5-10 years, I do not know which companies within the tech sector are going to be around in 5 to 10 years. I just know the sector as a whole is going to be booming in that time, which is why it's important to be diversified and use an ETF that tracks an index like this Aussie Tech Index. So I know what you're thinking. You look at the run that the technology index has gone up the last few years, or even the last 10 years, and you say to yourself, well, I've already missed the boat, you know, it's too late. And well, the answer is we don't know for sure. There's no way we can know if it is too late or it's not. But personally, I still think there's quite a bit more room for growth, and this is why. During the dot-com bubble, the NASDAQ 100 actually had a PE ratio of around 200 at its peak, and was growing at 40% per annum, can you believe it, all through the 90s for about 10 years. And if we compare this to the yearly returns of the Aussie Tech Index, they haven't ever exceeded 20% per annum in a single year. And in that same token, the PE ratio is still only around 70 to 80. However, in saying that, we all know, or we should know, that the PE ratio is not really a great measure of sort of evaluating technology companies. While historically it's been a decent measure for valuing more value-based stocks and financial companies, it really doesn't account for the growth multiples of the technology sector. And we can see that when you look at companies like Facebook and Google and Amazon. While they're on this big growth trajectory, their PE ratios are mad. And what you really need to look at when you're looking at these technology stocks is their sort of growth potential multiples. And that's what makes them so volatile to invest in. So now you know what the Australian Technology Index actually is and what it's tracking, and why I think there is still quite a bit more room for growth. But you're probably interested in what actually is in the index at the moment. So if we look at the top 10 holdings currently in the Australian Technology Index, they start off with Afterpay, then go to Xero, Computershare, REA Group, which is the real estate group, Altium, NextDC, Carsales.com, Appen, WiseTech, and Technology One. You can see this includes many really well-established names in the Australian market like Real Estate Group and Carsales, with a few up-and-coming giants like Afterpay and Xero. And I'll actually include a link to the index where you can see a full list of all the other companies that are currently in there as well. What's really neat about the Australian Technology Index that it doesn't just include pure information technology or service-based companies. It goes into some other industries like healthcare, finance, you know, with Afterpay and the buy now, pay later shares, and companies that are generally being innovative in their industry and operating sort of marketplace-like environments or using software as a service. And likewise, it's really great that it's got a bunch of companies that haven't necessarily graduated into the S&P ASX 200. So you really get exposure to a lot of companies that you wouldn't normally get exposure to. And it offers that earlier access to these companies who have great growth potential. So how to actually invest in this Australian Technology Index? So until now, Aussies really had to invest in global technology ETFs if they wanted exposure to the technology sector specifically. And this has been a very rewarding strategy, but you have missed out on all of these companies, specifically on the ASX, like Afterpay, like Zip, like Xero, who've really grown amazingly the last couple of years. So at the start of March, sort of just after the Aussie Tech Index was released by the S&P and ASX, BetaShares actually released their own ETF called the Australian Technology ETF, ticker ATEC, which since inception has already returned 13%, which is pretty incredible given the timing of the release of the ETF just being before COVID-19 and obviously the market crash that happened with that. So if we look at a few more details of the ETF, it's got a management fee of 0.48%, which isn't the lowest when you compare it to a low-cost Vanguard fund, but it's also not too high when you think about comparing to other technology ETFs or niche sector ETFs, which can, you know, be often even higher. So like for example, BetaShares has the Asian Technology ETF, which I think has a management fee of around 0.67%. If you are interested actually in checking out some of these other technology ETFs that are out there, check out my video that I've done, which actually goes through what I think is probably the top 5 technology ETFs, where I actually cover a lot of global technology ETFs, as well as technology ETFs that focus on a specific sector within technology, like cybersecurity, for example. And what is cool about this index and this ETF is obviously all the companies are on the ASX. So if you do want to just buy them yourself, you can, but it's probably going to be easier and cheaper for most investors, unless you have a significant amount of capital to deploy, to just invest via the ETF. And it also kind of saves you from potentially not following the ETF properly, or going too overweight in a single stock, and also just potentially panic selling or buying the wrong stocks. So the ETF is really useful, I think, for people who want a core allocation in their portfolio to the Australian technology sector, which contains a lot of companies that have a lot of potential for that capital growth. Or also as a complement to somebody who's got already a lot of investments in US or global technology companies through some of those other global technology ETFs like Tech or NDQ. And it's really great for people who might already hold like VAS or A200 because they like to invest and keep their money in the Australian market. But what it does is give you a lot more diversification within the Australian market because the ASX 200 doesn't really have a lot of technology companies and is extremely sort of overweight to those financials and mining companies. Ultimately, I just think it's great that Aussies finally have a way to invest in the Australian technology sector. I remember thinking, the last couple of years it'd be awesome if there was an ETF, and now there finally is. Especially when we're seeing this fantastic growth from all of these Australian technology companies. Also, I think one thing to note that is pretty cool about ATEX is it provides you a single and easy way to invest in the WAX companies on the ASX, which really didn't exist previously. But please remember, I'm not advising you to invest in this. Always do your own research and figure out if it's right for you. If you enjoyed this video and you found it useful, please smash that like button for the YouTube algorithm. It really helps me out. And if you want to see more videos about investing and personal finance, please subscribe to my channel. And finally, if you've got some questions or if you want me to cover a specific topic in the next video, drop a comment and I'll be sure to reply. Otherwise, I'll see you guys in the next one. Peace.